When you hear the word accounting, you probably picture, spreadsheets, calculators, maybe some dusty ledgers. But what if I told you it's actually a field of high-stakes problem solving? That accountants are on the front lines, tackling some of the biggest global challenges out there. Let's dive in, because accounting is so much more than just balancing the books.
So let's start with a classic rivalry. You've got two absolute titans of tech, Apple in the US, Samsung in South Korea. Now, if you're an investor and you want to know who's really doing better, who's more profitable, you need to be able to trust that their financial reports are telling the same kind of story. But are they? This isn't just a fun little puzzle, it's a massive problem when there are billions of dollars on the line. And this is where our first big accounting solution comes into play.
You see, what the world desperately needed was a kind of universal translator for business, a single set of rules so a company in Mumbai could be understood just as clearly as one in London or Sao Paulo. The mission was clear: create a truly global financial language. And the heart of this mission, something called accounting standards. Just think of them as the grammar and the vocabulary for this new global language. Their entire job is to make sure financial reports are transparent, consistent, and, this is the big one, comparable. I mean, without them, global investing would be a total shot in the dark, just pure chaos built on guesswork.
Now, a system this big didn't just pop up overnight. Oh no, this was a journey that took decades. It really kicked off back in 1973 with the IASC. By 2001, that group evolved into the modern powerhouse we have today, the IASB, which gave us what's known as IFRS, the International Financial Reporting Standards. And a really huge moment, a real turning point, was in 2011, when a massive economy like India decided to get on board. That was a game changer.
As this whole thing developed, two main ways of thinking emerged. On one side, you've got IFRS, which is principles-based. It's like a guide that sets broad goals and then trusts accountants to use their professional judgment. On the other side, you have the US system, called US GAAP, which is rules-based. It's much more like a massive, super detailed instruction manual that tries to cover every single possibility. It's really a difference in culture. The US system wants airtight rules to avoid lawsuits, while IFRS puts more trust in the pros to get it right.
So, after all that effort, the result is pretty staggering. Today, a whopping 144 countries require IFRS for their public companies. That is a huge, huge win for a single global standard. But the story's not quite over. As you can see, some of the world's biggest players, the USA, China, and Japan, are still doing their own thing, operating on their own long-established systems.
So what does this convergence actually look like in the real world? Well, let's get specific. If you compare IFRS to the older Indian standards, you see some major differences. For example, with IFRS, a parent company has to roll up all its smaller businesses into one big report to give you the full picture. The old way, nope, wasn't required. These might sound like tiny details, but for an investor, they can be the difference between seeing a healthy profit and missing a huge hidden loss.
All right, so we've made incredible progress in creating a global language for the numbers we can actually see. But that brings up an even more fascinating question. What about a company's single most valuable asset? The one that's totally invisible and never ever shows up on a balance sheet. Yep, I'm talking about its people. And this brings us to our second really big accounting challenge, the incredibly tricky task of trying to actually measure the value of people. How in the world do you put a dollar sign on skill, creativity, and experience?
Well, this idea actually has a name. It's called Human Resource Accounting, or HRA. And this quote from Flamhoyts just nails it. He explains it as measuring the investment a company pours into its people, recruiting, hiring, training, all of it, and then thinking of that investment as an actual asset.
Okay, but why would anyone even try to do this? What's the point? It's all about a fundamental mind shift. When you start tracking what you invest in your employees, you start making way smarter decisions about hiring, about training. It forces managers to stop seeing their team as just a cost and start seeing them as the engine that actually creates value for the business.
But, and this is a big but, this is where theory slams into reality. It is incredibly hard to do. For one, there's no standard way to do it. A lot of the methods are based on really old school assumptions, like that an employee is going to stay with one company forever. Right, and here's the kicker. Unlike a machine that just gets older and less valuable, a person can actually get more valuable with experience. How on earth do you predict that?
So, we've looked at making numbers clear and consistent, and we've talked about trying to value the things we can't easily count. But
What happens when those numbers become a weapon? What happens when they're used to hide the truth, to commit fraud, and to completely deceive everyone?
This is where our third group of problem solvers makes their entrance. Think of them as accounting's version of crime scene investigators. They're the ones you call when the numbers just don't make sense and you know something is very, very wrong. This incredible field is called forensic accounting. It's this perfect blend of accounting know-how, auditing skills, and pure detective work. These are the accountants who are trained to dig up financial evidence that's solid enough to hold up in a court of law. And if you want a perfect example of how crucial they are, look no further than Bernie Madoff's massive Ponzi scheme. The only reason we really understand the mechanics of how he pulled off one of the biggest frauds in history is because forensic accountants painstakingly took the whole thing apart, piece by piece, and laid it all out for the world to see.
So how do they do it? How did they crack the case? Well, it's a pretty methodical process. First, they analyze. They go way deeper than the surface numbers. Then, the real investigation begins, tracing money, finding hidden assets, and gathering all that hard evidence. And finally, they report their findings, either in a detailed report or sometimes right there on the stand as an expert witness.
And don't think this is just for huge, headline-grabbing frauds. These financial detectives work on a surprisingly wide range of cases. They're called in for criminal investigations, sure, but also to figure out damages in business lawsuits, to calculate insurance claims, and even to find hidden money in messy divorce cases. So when you pull back and look at the big picture, you see it, right? Accounting is this incredibly dynamic field that's always evolving. It's grown from just recording numbers to building a universal language for business, from trying to value people to literally finding the truth when the numbers are used to lie.
And as our world just keeps getting more complex, with AI and big data changing everything, you have to wonder, what's the next great challenge that's coming? What's the next impossible thing that accountants will be asked to measure?